Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday, the 15th of April 2022. As always, this is general commentary and doesn't take your personal situation into account. Alrighty, let's go to our first chart. So, S&P 500. Well, it's been a fairly uneventful week, really. We've continued to see the market pull back over the last few days, and what's that's been doing? It's really been correcting this big rally that we saw a few weeks earlier, and that rally was really, I think much of that rally was about short covering. Market got really oversold down here. A lot of negativity, a lot of hedging was going on, a lot of short positioning for further falls. And this is so typical of what we see when a market gets overextended in one direction, that it will snap back. And that was a snapback rally. And when that goes too far, it then pulls back the other direction. That's what we've been seeing. It's interesting. You might remember a couple of weeks ago I showed you a chart of the number of stocks, the number of S&P 500 stocks which are trading above their 20-day moving average. Just give you a quick look at that. So this is so the number of stocks trading above their 20-day moving average. A couple of weeks ago, we're up around 91, 92%, which is quite extraordinary because the market only gets. Let me just compress this chart. Get lots of data here, so it starts looking like a crazy seismograph chart. So going back to 2014. You can see the market only gets up here once every year, once every couple of years. It can go a long stretch without getting up there at all. But when it does get up there, it doesn't stay there for very long. And sure enough, that was the case this time. It didn't hold up there for too long. Now we're back to 43% of stocks above their 20-day moving averages. So it's a really good sort of indicator to keep an eye on for just trying to spot those short-term extremes. Works on the downside as well. Just compress that again. You can see once you get below, say, around 10%, once you've got about 10% of stocks above their moving average, it typically is a sign that you've got some sort of at least a near-term or some sort of a pivot low. Doesn't mean the market's bottomed completely, but you get some sort of rebound and some sort of unwinding of an overextended position. So just look, that's an interesting one to keep an eye on because it's worked really well this time, and it gave us that indication that the market was going to do that. We spoke about a 5% pullback, and we're smack on the 5% pullback now. So that's pretty much all gone to plan. But I think the easier part, well, probably I shouldn't say easier, but probably the more predictable part of this move, the rally and then the pullback, the more predictable part now I think is behind us, and I think it gets a lot harder from here. And the difficult part of all this is that I think we're in the part of the cycle where there's just no dominant medium-term trend, and I think there's a strong possibility the S&P 500 is going to trade back and forth within an extended range. So what I think is happening, I think we're now correcting this entire advance, and if that's the case, it's probably going to take time to do that. So one of the possibilities is that if we do have an extended range, maybe we could see price action in this sort of this is a sort of like time-wise, it could take that sort of amount of time to correct in advance of that duration. Look, this is of course all just complete. We're theorising on what could happen. We don't know what's going to happen. So these aren't predictions, they're not forecasts, they're possibilities. So my favourite case through the last month or two now has been that from here we continue to get a move higher up towards maybe a double top or just below the previous top, and then from there maybe the market would towards the middle of the year maybe we'd get another fall and a retest of these lows. That's one possibility. That's still my preferred case. It's still my base case, my favoured case. That's what could happen. But maybe it doesn't go like that. Maybe this market's going to continue to weaken off from where we are now. Maybe it is going to continue back down, and we're going to get this retest sooner. We don't know. We just got to see how it plays out, and address the price action as it comes. And of course, we could get something completely different. Just possibilities, just things to keep in your mind, so that the more prepared you are for possibilities, the better you are able to manage them. And as I always say, my way of managing these markets is buy with the trend, hold position while those trends are intact, give them lots of room to move with wide trailing stops, so you can see off these bouts of volatility which we're currently experiencing. So let's jump to a 4-hourly chart, and let's just focus in on this area through here. Okay, so 4-hourly, because 4 hours are good. They just give us that little bit more detail that you don't get in a daily chart. So what I want to do here, I want to put the Fibonacci's on, the Fibonacci retracement levels, and we're just going to measure out from the low to the high. And so here we are. We're right here at the 50% retracement. So far this has been pretty textbook stuff in terms of the big rally and the pullback, and that it's rallied hard, and now it's had that pullback, that mean reverting pullback, which has come back to the 50% retracement. So if we're going to get a bounce, and we're going to get that next leg higher, which I still think is possible, we got to move up towards 4,600, which is this previous high, or even could even extend up to 4,800. If that were to happen, I think it really needs to engage now. It's got to kick in pretty soon. We've got to see the buyers come in and start supporting the market here, buying this dip and pushing it higher if we're going to see that bounce. Still my base case, but look, it really does need the buyers to come in and support it here to get, if we are to get that retest of 4,600 or potentially higher. And look, we'll know quite a bit more over the next few weeks to see whether that actually starts to take shape. But overall, I don't think we have the backdrop for a new bull market in US stocks at this point. It's while the S&P 500, which we're looking at here, structurally it looks okay. It looks like it needs to pause, needs to work out some sort of probably an extended consolidation. It does look structurally okay. It's I do think we are in that part of the cycle where it is still going to take time, and I think a lot of investors are going to find this quite frustrating. In that we're going to have some stocks rising, a lot of stocks just sideways, range bound, stuck in the mud, and others which are going to be falling. It's going to be a tricky time, I think, and this could play out for several months. Could well play out into the middle of the year or even beyond. And I'll show you why I think this is going to take a bit of time. So just quickly, let's just see how far this is from the all-time high. So it's only 9% off the all-time high. That's not too far. We're pretty close to all-time highs in the S&P 500. Let's jump to the Nasdaq, because quite a different story when you go to the Nasdaq. Because if we look at how far it is from its all-time high, it's close to 20% off its all-time high currently. So that's a very different look to this market. It's a lot weaker than the S&P 500. And I think it's going to take time, because again, I think we're correcting this whole move, and this correction is already deeper. It's going to take time for this to work through. It's going to need to, we don't know the pathway it's going to take. It's going to need to stabilize at some point. It could be the same sort of look as the S&P, where we go up and then we come down and we retest the lows later in the year. Could take any number of pathways, but I think the big thing is it's going to take time to work its way through. If we can put some Fibonacci's on. Let's just do the Fibonacci retracement of that recent gain, And look, we're down at the 61.8%. So again, this is one of those situations where if we're going to get some sort of an upward reaction and start forming a range within this this area here, it really needs to get going. The buy on dip traders need to come in, support the market, give it a push to the upside. Interesting whether if you've got a keen chart eye, interesting whether you've spotted this pattern on the chart. Just draw that neckline in there, and you have the makings of a head and shoulders bottom. So you've got the shoulder here, potential shoulder here on the right side, and then you got the head. So the theory with this would be if the market can start to get a bit of a move along here and start to move up, could get back to the neckline there, maybe a pullback, then a punch through, return move, then another move higher. So that's a possibility. That's a possibility that we are forming a bit of a head and shoulders bottom there. But I don't think this is a sort of head and shoulders which is going to propel us to a new all-time high. Because again, I think it's going to take time. But it is interesting to sort of see that structure start to fall, in that the market may struggle to continue to pick up downward momentum here. This is where the head and shoulders works, in that the right shoulder doesn't continue the momentum which we had in this period here, falls short, and then it starts to rebound in the other direction. So that would support that case of we do get that retest up towards the highs, and then maybe from there, again we'll have to assess it as it plays out, maybe from there later in the year, second half, we get a return move. But again, as I keep saying, I think this is a tricky part of the cycle. It's a harder time to make money, and it's a time where you want to be careful with your capital. It's trade the signals which look good, which appear to offer good risk and reward, but don't be in a hurry to take marginal trades, because this is where you can easily lose money as markets chop in these ranges. Now, we haven't looked at this market for a while, but I want to have a look at the Russell 2000, because this is telling its own really interesting story. And it's another clue to me that these US markets, where the upside could be limited over the next few months. So Russell 2000, it's an index of small to mid-cap stocks. The size of the companies ranges from something like, say, 200 million, maybe through to about $2 billion. And they make up sort of pretty much your middle America stock. So this is an index which I think is a bit of a barometer for the US economy in general, because you've got all those rank and file stocks which make up so much of the economy. And now let's throw some moving averages on this. Let me just see, where are they? Here we are. So I've just put on the 50 and the 100-day moving averages. And what really strikes me about this chart is that you can see just here, well, the moving averages have crossed and turned lower, and the price is currently trading below both the 50 and the 100 day. So that's a vulnerable position. A market is always vulnerable when it's below those moving averages, and this is where the bad stuff can happen. Doesn't always happen, so it's not to say something bad's going to happen, but this is where a stock's or a market is vulnerable to the downside. So we need to be mindful of that, and it's another reason why it doesn't look like the S&P 500 to me is going to go charging up to new highs anytime soon. And another thing which is worth noting, it's this big resistance band through here. So this picks up all these lows. So this was a big support band until recently, when the market broke down in January, and now it becomes resistance. And you can see it's butting its head up against this resistance now. So this resistance band is really pinning the Russell down. It's pinning it down, and whilst we're below there, as I say, the vulnerability is that this market does continue to come off. I'm not suggesting it's going to crash, but you could see further downside. If we're seeing downside in the Middle America stock, it doesn't make sense to me that would be seeing the S&P 500 surging, given it's largely made up of those mega cap stocks like Apple, which are at the moment really holding it, really bolstering it. So I think for the US markets, I think the best case is that we see some sort of extended consolidation, at least until we get the see signs that the Nasdaq and the Russell have started to base and started to turn higher. And that's inevitably going to happen, but we just don't know when. So let's just keep watching the charts to give us an idea of when that could be. And we can maintain defensive positions in our stocks whilst we're going through this period of consolidation, which is normal, which is healthy for markets, which is all part and parcel of the game. So let's go to the ASX 200. But before that, please, if you're getting some value from this, please hit that like button and leave a short comment, really short comment. Hey Jason, like the video. Something really simple. Tells YouTube people are watching, they're engaging. YouTube shows more people, and I'll make more videos. So that really helps. So please do that. And just quickly, thank you to all the people who leave those comments week after week. I see those same names there so often. I really appreciate it. Love reading all your comments. I've tried to respond to everyone in the past, but I get too many comments and too many things to do, so I just don't get to everything. But I read it all and I love it. So please keep leaving those comments. And so now ASX 200. So this is quite a different picture to what we're seeing in the US, because the ASX 200 looks structurally strong. It's a market which, well, the dominant pattern here is this double top resistance, which we have at around 7,600. And the market really seems to be setting itself up for new all-time highs, which is really in stark contrast to what we're seeing in the US. And often I've seen this sort of pattern resolve like this, where you got the double top, falls away from the double top, but then comes pretty much straight back, sits below the double top, coils up like it's kind of doing at the moment, and then punches through. That is a setup which I've seen so many times in markets. Now, it doesn't guarantee it's going to happen. The market could, of course, do something different. Maybe it does. Maybe it stalls here and starts to roll over again. You know, you can't discount that that's going to happen. But at the moment, my base case would be, even though it's against the grain of what we're seeing in the US, is that it is going to punch to new all-time highs. You know, it's hard to envision that the Aussie market does its own thing, but you never know. So I'm all about being guided by the price action, not about opinion and biases about what could be happening elsewhere. It's follow the price action and let that guide your decisions. And sometimes you look back after following the price action and go, wow, I didn't see that coming, but look where I am now because I got on a trend. I just let it run. So that's the way I trade these markets. It's go with the price action, and it could be the case that we're entering a period where the ASX 200 outperforms. It's happened in the past. Last time it really happened was during the 2000s, say between 2000 and 2007, thereabouts. Could be entering another period like that now. Time will tell. We'll see how that plays out. And just one other thing, which is really interesting, my Motion Trader service gave about a dozen new buy signals yesterday for Tuesday's open after the Anzac, after the Easter weekend, and most of those signals were for resource stocks, which is interesting in itself because that could be the fundamental thing which is going to drive the Aussie market. And it's so interesting. Some of the names I'd never heard of before, and that's often the case. It's like the amazing things that algorithms do when you scan a market of 2,000 odd stocks. You often get some of the best opportunities are in the stocks that almost nobody knows, or nobody knows yet until they become boom stocks over the next 12 or 24 months. So who knows whether they're in yesterday's signals. But that's how you come up with these. How I come up with these names, which I've never heard of, by doing these algorithmic scans. And a couple of stocks we've been talking about recently came up in the scan. So I'll just quickly show you those. So one of them that came up was one of our uranium plays. We were talking about this. I think it was last week or the week before. Boss Energy. So if you're watching the last couple of weeks, you remember I put in this support support zone here the market was holding above. And I said, look, I've just bought some in here, and I think it's a really good asymmetric opportunity in that you can buy here, and you can put an exit stop just below the support, say at around $2.10, something like that perhaps. So you're risking maybe 10% to get into a stock that could double, treble, or more. And that's, look, it's off to a good start. Who knows where this goes? But we're now getting to the point where it's nearing the top of this big trading range, which has been in since September last year. Look, it doesn't have a clear top, but you're getting close to the point where you'd say, look, it's breaking out of this range. Interesting to watch this space over the next few weeks to see whether we do. Look, it's let's just quickly throw the moving averages on. Yeah, look, it is running quite a bit above those moving averages now. So this is a point where it's getting close to saying, look, it may start to consolidate. So we've got an entry signal based on that it's broken to a 70-day high. It's broken above there. It's above the moving averages. But quite often with the signals which I get, a signal doesn't mean a stock's automatically going to just keep charging. Sometimes you get the signal because the underlying momentum's in place, but then you get a pause. And with where Boss is now, maybe the pause comes in like this and then shoots higher again. Could see something like that. Give them moving averages some time to catch up. But that was an interesting one. That was an interesting one to see Boss come up in the signals. And also another one that came up is another stock we've spoken about recently, Evolution Mining, so a gold stock. And you can see it's making a new high here. We've been talking about it. Look, we've been talking about it for probably, for quite a while now, 4 or 5 weeks. It's good to see that momentum coming through. The moving averages are up. Stocks come back, tested the moving averages, rebounded. So it's doing all the right things. So let's just see how that continues to unfold. And if you're interested in what I'm doing over at Motion Trader, maybe grab a free 2-week trial and come over and have a look and sort of see the sort of stocks that we identify. And I think you'd be amazed at some of the companies that an algorithm can find. I know I certainly am. So what I'll do, I'll leave a link at the top of the comment section if you want to come and take advantage of that 2-week free trial. All right, so what I want to do now, I want to move onto gold. I've got an interesting gold chart to show you. So this is the ASX Gold Index, and interesting things happening in this. So I want to test your chart eye just for a bit of fun, and tell me, just have a look on the right hand side of this blue line. Tell me whether you can spot a pattern. Tell me if you can see a technical pattern in that part of the chart. Maybe just pause the video for a moment and have a close look. So let me just draw it in. What we have on the gold index is a bullish wedge formation, and you kind of had a little bit of a clue in that last chart of Evolution where I had the wedge already drawn in. But these are the sort of patterns which I like to look for when I go through the charts manually just by eye. So I use algorithms to find the opportunities nowadays, but I always then will look at it and just see what patterns I can spot. It's interesting. It's where it's where I got my original training in the charting department, learning how to old school classic chart analysis, and still love it. Really interesting to look at. And so look, we've got this bullish breakout. So this is we've had this. It peaked in July 2020, and we've had the sell-off, lost momentum through this bullish wedge, and now we've got this turn higher. We had the breakout in February, March. We've been talking about this through Trade the Trend for a month or two now, but you can see this is now starting to really gather some momentum. By the dip opportunity was just back here in the last week. We came back towards those moving averages, just kicking higher again. So it's good to see that we're now starting to build this sequence of higher highs and higher lows. And if this continues, another pullback, another higher low, another move up, and that sequence really starts to develop. So that's a sign of an underlying market which is which is developing into a good sort of trend. And it's encouraging to see the buy the dip traders coming in and supporting these pullbacks. And lastly, there's one other chart to show you, which is a really interesting one in terms of in terms of gold versus the rest of the market. So this is the ASX Gold Index, which we're just looking at, divided by the all ordinaries. So it shows you what's performing. Is a gold stocks outperforming or underperforming the broader market? So I'm going to put this onto a weekly chart to gain some more perspective. And the data for this goes back to around 2001. So when the chart is rising, gold stocks are outperforming. When it's falling, gold stocks are underperforming. Since 2015, we've had the emergence of a new period of gold stock outperformance. It's still establishing, but I think it's gaining momentum. So we had a period of gold outperformance there. Then we had the long consolidation, another surge in gold performance, another consolidation. I think, and like you never know, it's just a possibility, but I think we're at the point where we're going to see this start to move higher again, start to maybe make a new high above here. So a period of gold stock outperformance. So this is a medium. We're looking at a chart with 20 years worth of data here. So this is a medium to longer term play, but it's just going to be interesting to see whether those gold stocks are moving into a period where they do outperform the broader market. So look, let's call that a wrap for this week. Thanks for tuning in. Hope you got something interesting out of that. Please hit that like button, and I look forward to coming back and talking to you next week. Until then, bye for now.